Hello everybody, this is the last video of the whole course, so the only video for chapter 8. The objective of this chapter is to discuss the use of derivatives by um, various financial institutions related to actuarial science. Okay, so there are other financial institutions such as, for example, banks, but we won't discuss them. We'll mainly stick to insurance companies and pension plans. So the actors we're gonna discuss, we're gonna start with life insurers, then property and casualty insurers, and then we're gonna finish with pension plans and see how these institutions they use derivatives in practice. So this explains why all the material we've seen in the course is relevant to them. So how do how are derivatives relevant to the business of life insurers? Well, to answer this question, we must first understand what life insurance companies issue as products. So life insurers, they mainly sell products to individuals which provide benefits that are contingent to either the death or the survival of a policyholder. So, for example, life insurers they issue life insurance where an individual or at least its beneficiary will receive a benefit if the policyholder dies, whereas they also sell annuities, which are stream of payments which last until the policyholder dies. Okay, so for example, if somebody wants to retire and to make sure they have a steady stream of inflow for the rest of their life, they can purchase an annuity which will guarantee that the stream of payments will not stop before the end of their life. So in these products, there are, of course, many versions. For those who've done actuarial science classes, you've been in contacts with the various products that are issued by life insurers. And the various versions, sometimes the payments or the benefits provided by the products can be fixed, so the amount is predetermined. For example, you're going to receive $20,000 a year for the rest of your life or something like that. Or sometimes there's indexation promises. So for example, it's $20,000 a year, and then this amount will increase with inflation through time. Or they can be variable. So sometimes the benefits are provided by either the annuity or the life insurance is unknown at the onset of the contract, and the benefits promised they evolved as a function of the evolution of some risk factors such as stock prices or interest rates. So in some products, if stock prices go up, then you'll have a higher benefit than if they don't. So there are all many different forms of life insurance and annuities which have different forms of benefits. The purpose of the current chapter is not to discuss them in depth, but just to let you know in general that this is a core business of life insurers. So we said that payments can be either variable or fixed. But for those who are variable payments, they typically come with some embedded financial guarantees. Okay, so for example, if the payment is variable, the insurer might guarantee the policyholder that the level of his payments will not drop below a certain quantity. Okay, so put a floor on the level of benefits provided to the policyholder to make sure that there's no financial hardship for the policyholder. Okay, so these guarantees, they provide payoffs that are, of course, paid to the policyholder or the insured. And these payoffs, they often look like and behave similarly to payoffs of financial options. sometimes exotic options. Okay, so options on interests or equity. We're gonna discuss that a bit more in depth shortly, but since these guarantees they provide payoff that look like options payment, then insurers in practice when they value them or when they manage their risks associated to these guarantees, they treat the guarantees as options. So they can use traditional option valuation methods such as the ones we've seen throughout the current course. And of course, uh, same than for regular options, these guarantees they represent a risk for life insurers. Okay, so for example, if the life insurers they guarantee a minimum amount of payments, well, sometimes uh, these guarantees can become costly for the insurer. Okay, so if the asset, for example, uh, sometimes the okay, we'll discuss that shortly, but depending on the financial situation prevailing, the payoffs from guarantees might be higher than in some other circumstances. So these represent risk to insurers, and they also must be hedged in practice. Okay, so insurers use hedging techniques to protect themselves against the payoff of the guarantees, which are in fact implicitly options. So to hedge their portfolio of guarantees or options, there are multiple techniques that exist, some that we've discussed throughout the current class. So a first technique is dynamic hedging with simple products. So for example, some insurers might delta hedge their guarantees. So for example, sometimes the guarantees they behave like put options on stocks. Okay, well, they can calculate the delta of these put options and purchase or sell shares of stock such that the total delta of their portfolio, including their uh, guarantees and their hedging assets, the stock sold short, the net delta of the total portfolio is zero. Okay, so exactly as we've done in the chapter covering the Greeks. There's also static hedging strategies. So instead of dynamic hedging, so dynamic hedging entails that at every period, so for example, every day, or it can be every week or something like that, they rebalance their hedging portfolio with simple assets. Okay, so if you're selling or purchasing stocks, it's very easy to sell or purchase them so that you can adjust your hedging portfolio. Okay, so this is similar than what was done, for example, in Chapter 2. You can try to build replicating portfolios for the payoffs of your guarantees by trading dynamically in the stock or the underlying asset of the guarantee. Conversely, static hedging, they don't rebalance it entails not rebalancing the portfolio at every period, but instead you purchase a single time assets or more complex options whose structure is similar to the guarantees issued. Okay, so that automatically the payoff of the hedging assets you purchase, they look like the payoff of the guarantees, so that if for example, guarantees provide a payoff of, I don't know, 1 million to policyholders. Well, your hedging asset should provide you also roughly 1 million to offset and the risk and protect the insurance company. So here, the objective is static hedging is to make the assets you purchase and the liabilities that you have towards policyholders, which are guarantees here, similar. And by being similar, they have, if you give a payoff on one hand, you should receive a similar payoff on the other hand, and this protects you against risk. So for static hedging, one issue is that the the guarantees embedded within life insurance contracts or uh, annuities contracts, they have typically very long maturities. So, for example, 10, 20 years, 25 years, something like that. So, there's no options with maturity 25 years that trade on regular financial exchanges. Okay, so if you want to buy a 25-year option on the S&P 500 and you go on the like well-known uh, options exchanges, then you won't find these. Okay, so typically maturities available in uh, options for options in like stock exchanges or something like that, they don't go beyond like maybe 1, 2, sometimes 3 years or something like that. But higher maturities than that, they don't typically trade. So if an insurer would like to purchase these kind of options with very long maturities or with other exotic features, so this I haven't mentioned previously, but sometimes we said that there's a floor on the payments provided to the policyholder, but sometimes this floor evolves through time too. Okay, so not only the promised uh, the like benefit of the policyholder evolves, but the floor level could evolve through time. So sometimes insurers they implement what we call ratchet provisions. I don't necessarily want to go in depth about this topic, but ratchet provisions they entail that once in a while, if for example the stock market goes up by more than 15%, then the floor level will be increased by 15% or something like that. This is just an example, but the minute the guaranteed amounts, they which act often as the strike price of the option, they evolve through time. So in that case, the options or the liabilities, they behave like exotic options instead of regular options because their strike price or guarantee level might change through time based on the evolution of some risk factors. Okay, so we see that guarantees embedded into life insurance contracts or annuities contracts, they are very atypical options, and you cannot just buy similar ones in a regular public options exchange. If you want to have tailor-made structured deals which whose payoff look pretty much like the ones from your liabilities, or not pretty much, but at least has some common features, then most likely you'll have to either go to investment banks to uh, get these type of structured deals which have exotic payoffs, which should at least have some similarities with the payoffs of your liabilities, or alternatively an insurer can undergo a reinsurance, so insure itself. So reinsurers are insurers are of insureds, and in that case, this would be equivalent to hedging a portion of their portfolio. Uh, so this is like reinsurance. It is a traditional approach in insurance. Okay. So a particular case of a contract with a variable payment is what's called variable annuities in the United States, or in Canada, this is often referred to as segregated funds. So how these policies work in practice? Well, an investor, so somebody, let's say somebody's 45 years old, he can take his savings and invest them into some account, and this account is invested in a mutual fund. Okay, so the mutual fund can contain, for example, equity, fixed income, money market assets, or other types of assets. So in the variable annuity contract, the insurers will periodically charge fees to that account. So let's say every year they're going to charge 2% of the account as fees. But in turn, they will guarantee to the policyholder a minimum level of benefit uh, where okay, would there be no guarantee, the benefit would be equal to the account value at the maturity date of the contract. So the account is invested in the mutual fund. The mutual fund moves, but every year uh, or every month or whatever, you have fees charged to the fund, to the account, but it evolves randomly. And then often there's a guarantee which says if at the maturity of the contract your account value lies below some barrier or some guaranteed amount, then the insurer will make up the difference between that threshold and your account value to push it up back to that threshold. And then at the maturity date, the policyholder will collect its account value. So we see that, so this can be either at the maturity date of the contract, or these guarantees, they also exist in the form of a life insurance, which is you look at the date of death of the policyholder, and if at the time he dies, his account value is below some guaranteed threshold, then the insurer makes up the difference to push up the account value to the minimum level, and then this account value goes as benefit to the beneficiaries of the policyholder. So we see where the risk lies here. The risk lies in scenarios where, let's say, so this is a guaranteed amount, and here the mutual fund evolves through time, and if on the a given event, so either death of the policyholder for some contracts or survival of the policyholder at a given date in other types of contract, if the account value goes below the guaranteed amount, then the insurer has to pay the difference from its own pockets. So this is where risk lies. So if, for example, stock prices crash suddenly, then the mutual fund might go much below the threshold, and the insurer would have a lot of money to pay. So here we see why there's risk, because the account value depends on values of bonds, of stocks, and thus the payoff of the guarantee or the variable annuity will depend on ultimately the price of stocks or interest rates. So in that case, for variable annuities, the guarantee, it behaves like a put option on the account value, where the strike price is the guaranteed amount. Okay, so why is that the case? It's because the account belongs to the policyholder, but let's say it plummets below a guaranteed value, then if the account remains above the guaranteed value, then there's zero payment needed to be made by the insurer. Okay, so the insurer will give back the account value to the policyholder, so there's zero payment from the insurer. But if the account value lies below the threshold, then the insurer will have to pay guaranteed amount minus the account value. So we can see that the payment by the insurer in that case looks like maximum between 0 and a guaranteed amount at time t minus the account value at time t. So here t, it's either a fixed date for some contracts, okay, and here the fixed date, so sometimes the payment is contingent on the policyholder surviving or something like that, but sometimes the t is a fixed date, sometimes t is a random variable which denotes the time of death of the policyholder. Okay, so we can see that this contract, it's really a put option where the strike is the guaranteed amount and the underlying asset is the account. And since the account is invested in a mutual fund, typically containing stocks or bonds, then we see this is a risky component. Okay, so you can treat that as the underlying asset of the option, which behaves like stocks or something like that. Okay, so we can see that the guarantee acts like a put option on the account value where the strike is the guaranteed amount. Okay, and here sometimes GT, the guaranteed amount, it's fixed through time, so it would be it would look like a regular option, but sometimes the value of G varies through time, fluctuates through time. So in that case, would be some exotic options. Okay, so how does the guarantee amount fluctuate through time? There are many ways that this is done in practice. One of them is the ratchet provision I briefly mentioned, but there are other ways to do that. I don't necessarily want to go again in depth about that. Please do a more advanced life insurance class if you want to learn about these. Okay, so, yes. So we can see that for life insurers, they're very interested in option pricing theory, option risk management theory, etc., because the products they issue to some policyholders, they contain some guarantees which behave like options. Okay, so understanding how options work is very important for them. Now we're going to turn to a second type of insurers, which are property and casualty insurance. Okay, so property and casualty, they insure against, for example, fire, robbery, or wind damage or something like that. Damage to not to human being, but rather to properties. So the nature of the liabilities of a property and casualty insurer is pretty different from these of a life insurer. Okay, so contrarily to liabilities of a life insurer, liabilities of a property and casualty insurer, they're not very sensitive to either interest rates or equity markets. Okay, so typically the maturity of a liability of a property and casualty insurer is very small. So when you insure your car, it's pretty much 1 year at a time. So the insurer, they have a liability towards you for 1 year, not 20 years like a life insurer, for example. Okay, so this very short maturity of liabilities, they imply that discount factors or interest rates, they don't have a very material impact on the liabilities. Okay, so the liabilities are not very sensitive to interest rates, neither to equity markets, because the benefits from the insurance, they're mainly influenced by accidents, catastrophic events, or something like that, which is not dependent directly on equity market. So of course there might be some correlation between both. So if there's a big catastrophic event, the equity markets might plunge or something like that. So it's not fully independent, but the relation between benefits and equity markets is not as strong as for life insurance company, whose, for example, the benefits, as we discussed in the variable annuities case, are directly tied to the performance of the stock market. Note, however, that claims are very influenced by inflation in the case of property and casualty. So these insurers, they track this risk factor very closely. Okay, because if the cars, they increase in value suddenly, well, and if they have to pay back the value of your car, well, they're gonna have to pay more if there's higher inflation. Okay, so do property and casualty insurance use derivatives? The answer is yes, but not necessarily the same ones than the life insurers. Okay, so we saw that for life insurers, the benefits were highly influenced by interest rates or equity. So equity and interest rate derivatives can be very relevant for life insurers. Now, for property and casualty insurers, options on stocks or options on interest rates, they're not as interesting because they don't look, their payoff doesn't look as much like their liabilities. So instead, there are other types of derivatives that are tailor-made for property and casualty insurance. So the first one we're going to discuss is weather derivatives. The payoff of a weather derivative is contingent on the occurrence of a climatic event. Okay, so for example, there are many weather derivatives that whose payoff depends on temperature. So here, many of them have a payoff of this form, maximum between 0 and t minus k, where k it's the fixed value. It acts as the strike price, and the underlying asset well, it's not an asset here. Okay, so we're going to call it the underlying value. The underlying value T is a temperature index which represents the average temperature at a given predetermined location for a given time period. Okay, so for example, it could be the average temperature in Montreal for the month of January or something like that. So this type of derivative can be very useful if for insurers when the damages imposed to policyholders is very dependent on temperature. So for example, if you're insuring the crop of farmers, well, let's say the summer is very hot. A lot of farmers might lose their crops because of droughts. So in that case, insurers, if there's a very hot temperature in the summer, insurers might have to compensate farmers very heavily and pay a lot of money. So to protect themselves against that risk, they could purchase these type of derivatives, which would give basically zero payoff if the summer is cool, but a very high payoff if the summer is very hot. So we can see that this type of option would provide cash flows in scenarios where insurers would most need them, and zero cash flows when insurers don't need them. Okay, so we can see that the payoff of this would be correlated with liabilities of property and casualty insurers in that case we discussed. So this asset would be very good to manage the risk of the insurer. There are other forms of weather derivatives, okay, where instead of having a temperature index which drives the payoff is driven by the damage done by some given climatic event. Okay, so for example, I've put an example here. Instead of having temperature, we could have the following payoff. The damage weather derivative, it pays the amount of damage in excess to some base amount if a hurricane of category 2 or greater occurs. Okay, so for example, you can have a contract of the form, the following form. It's going to pay any damage beyond X amount of money if that damage is caused by a hurricane of category 2. Okay, so we can see that this still behaves like a call option. Okay, if the damage is below, well, if there's no hurricane, you have zero payoff. But if there's a hurricane of category 2 or more, the payment by this weather derivative is either zero if there's no damage, or if the damage is below some fixed level K, or the damage minus K if the damage exceeds the level K. So this acts like a call option where the strike price is the damage threshold and the underlying quantity is the amount of damage made by the hurricane. Okay, so these work. We can see that this is still useful for a property and casualty insurer, because if an insurer insures people against damage from hurricanes or wind damage, so for example in their home insurance or something like that, then we see that again this damage derivative will provide a payoff whenever the insurer needs it to pay policyholders, and no payoff when the insurer doesn't need money much. Okay, so again, this is a nice risk management tactic to use that to make sure that you have available funds when you need them. There's another popular type of derivative which is used by insurers to protect them, to mitigate their risk. It's catastrophe bonds. Okay, so these are often called cat bonds. Okay, so if you see cat bonds here, this refers to catastrophe bonds. And the functioning of these bonds is it's a bit more complicated than traditional bonds, but it's pretty interesting. Okay, so the reason why these bonds exist, it's because sometimes insurer wants to transfer insurance risk to broader financial markets. So they're not stuck with the risk. So maybe some investors in the broader financial markets, they would be ready to bear on some insurance risk as long as they're compensated for it. So this is a sound way to transfer risk, catastrophe risk from insurers to a broad financial market. Okay, so here I'll draw some picture here to illustrate how it works. So in the case of a cat bond deal, okay, so here this is the insurance company. Okay, these are investors. So instead of writing insurance, okay, this is some investor. Okay, so typically how it works, there's a separate entity or a company that is set up only for that deal. Okay, so this entity, often it's called a special purpose vehicle, SPV. So why is there a separate company that is created? It's because if that company goes bankrupt, it would not cause the bankruptcy of insurers. Okay, so you don't want insurers to go bankrupt if something goes wrong. So this is why these special purpose vehicles are created. Okay, so in these deals, the entity, the SPV, it issues a bond. Okay, so it issues a bond. So by selling a bond, the investors will give the capital to the SPV. Okay, so insurers, they purchase a bond. They give the capital, but they want to receive interest. Okay, so here the SPV must give them interest, but here, how will receive these interests? Well, these interests will be paid by the insurer. Okay, so here you have interest payments that are paid by the insurer. Okay. So this seems nice, but now, so the investor receives capital and gives the capital, receives interest, but here the insurer only pays interest. Okay, so what's in it for him? This is what we're going to see in the next slide. It's too bad I can't copy paste this picture, but maybe I'll repeat it in the next slide. Okay. So now, if no catastrophe occurs, then the bond face value along with interests will be returned to investors. Okay, so let's do again. So this is the insurance company. This is the SPV. And this is the investor. Maybe let's take another color. So here the investor, initially it gives the capital, receives the interest payments from the SPV, but where the interest payments were provided by the insurer. Okay, so then if after a few years nothing happens, there's no hurricane or tornado or anything like that, and there's no damage that needs to be repaid by the insurer to policyholders, then what's going to happen at the end of the deal is that the capital will be returned back. Okay. So then, if there's no damage or no catastrophic outcome, then the investor will be happy because they lended capital and they received interest rate payments along with the capital a few years later. So this behaves exactly like a regular bond deal for the investor. You give capital, you receive interest payments, and then your capital back. So for the insurer, they have paid interest payments throughout the deal and received nothing, but it's fine because there was no catastrophic outcome, so they didn't need to pay a lot of money to policyholders. Okay, so they lost a bit of money on that deal when there's no hurricane, for example, but they're fine with that. Conversely, if there's a catastrophic event, which where there's some damage caused, for example, by the hurricane, and the damage exceeds some threshold, what happens then? Okay, so then let's erase this. If there's a catastrophic event, I'll take another color, let's say maybe this one, then the SPV will take a portion of the capital and pay and give it to the insurer to cover the damage. Okay, so in that case, if there's a large damage, the insurer, yes, it will have paid interest payments, but it will receive a portion of the capital to cover some of the expenses related to paying policyholders. Okay, so in that case, at the end of the deal, the remainder of capital not paid to the insurer will be paid to the policyholder, to the investor. Sorry. So here, if there's a very high damage to policyholders, the insurer will be this deal will be profitable to insurers because they will have paid interest, but they'll have received a higher amount of capital. Okay, so we see that for the insurer, this deal makes sense. Okay, so they're going to lose money on the deal if nothing happens, but they're going to earn money from that deal if there's a catastrophic event. Okay, so this is very important to them because when do they need cash flows? They need more of them when there's a catastrophic event. So this deal provides them more cash flows when there's a catastrophic event, and the insurers are fine with losing a bit of money on that deal if they don't have to make large payments to policyholders. So now conversely, what happens for the investor if there's a catastrophic risk? Then the investor will have paid capital and he would have received some interest rate payments and only a portion of the capital he sent. Okay, so if the portion is small, let's say they receive only back 20% of the capital they initially gave to the SPV, then the investors will lose a lot of money from that deal. Okay, so now for the insurer's perspective, it's pretty clear why it's worth it. Now for investors, why would somebody go into that deal? Okay, so why would investors be ready to sacrifice a bit or a large part of their capital if there's a catastrophic event? The reason is simple. Because they incur more risk, the interest rate payments associated with these bonds are much higher than for regular bonds. Okay, so investors in that case, they bear higher risk, so they have to be compensated for that, and this is through higher interest payments. Okay, so if there's a catastrophic event, investors will lose money, but if there's no catastrophic events, investors they won't lose money, and not only that, they'll make much higher profits through much higher interest rate payments than if they invested in regular bonds. Okay, so we see that for the investors, going into this type of deal is what did I want to say? Is a way to absorb a portion of the insurer's risk and have potential compensation for it. Okay, so if there for the investor, if there is a catastrophic outcome, they lose money. If there's not, then they're gonna earn a lot more money than they would have if they invested in regular assets. So we see that the investors in that case, their payoff profile for this deal is similar to the one of an insurer. So this in fact transfer a portion of the risk of the insurer to the investors, and now investors behave like insurers. So this catastrophic or catastrophe bond, I believe it's very interesting, and it's a very nice innovation of financial markets. Another quick remark here is why why investors would want to invest in that. It's because the correlation of losses or profits in these deals is not very large with regular financial markets. Okay, so the occurrence of a hurricane, yes, it has an impact on stock markets, but the impact is not like one for one. Okay, so there's some decorrelation between payoffs of catastrophic bonds and payoff or cat bonds and payoffs of regular bonds. So because of that, this decorrelation entails diversification. And we saw in Chapter 4 that investors, to reduce the risk they face, they want to have some amount of diversification. So cat bonds can be an interesting instrument for investors to achieve diversification in their portfolios. Okay. So now we discussed property and casualty insurance. We're gonna go now to pension plan managers. What type of derivatives would they want to use? What's the relationship between pension plans and derivatives? This is what we're gonna discuss. So how do pension plans work? Well, their manager, they take the contributions of either employees or employers, and they invest these contributions or assets to grow them, make them grow and become sufficient in the future to pay the benefits promised to the employees by the pension plans. Okay, so the pension plan funds or the assets of the pension plans are typically invested in a mix of assets such as equity and fixed income. Of course, there are other alternative asset classes. So, for example, there might be a real estate, or you can even have the cat bonds that I talked about in the previous slide. Other like infrastructure deals, private equity, etc. So the assets of pension plans are quite diversified, but they often contain a great deal of equity and fixed income. The managers of pension plans, they want the plan to remain solvent. And what do we mean by that? They don't want to have the present value of liabilities. So liabilities, they're in the future, but we can calculate their present value to determine how much they should be, how much money you need now to cover them in the future. And they don't want that present value, so the value of liabilities, to exceed the value of assets in the pension plan. or at least not by much. Okay, so if the liabilities they exceed by 1% the value of assets, or like by 3% or something like that, it's not a big of an issue. But if the value of liabilities is 40% higher than the value of the assets, then you're going to have a big problem. So pension plan managers, they don't want the value of their assets in the plan to go below or much below the value of liabilities. So let's recall again, what are the assets and liabilities of the pension plan. The assets are the funds obtained through contributions of the employees and employers, which are invested in like stocks and etc. And the liabilities are payments in the future that are promised by the plan sponsor. Well, by the pension plan, but of course the pension plan is managed by the sponsor of the plan. So, pension plan managers, they are deeply concerned by scenarios where the asset value plunges or suddenly shrinks, or so either the asset value. So let's say if you have equal assets and liabilities, then you're fine. Your plan is solvent. But the scenarios which are concerning is the following. So either there's a sudden drop in the value of assets. So if assets go down, then your plan becomes insolvent. Or if the liabilities suddenly go up, then you also have a problem because your solvency ratio will plunge below 1. So you'll have liabilities with higher value than your assets. Okay, so sometimes they move like this in a similar direction, but sometimes, for example, even if they move in similar direction, one might move more than the other. So if you haven't moved like that, then you're still in trouble because your liability is higher than your asset. Okay, so how to protect the pension plan against these adverse scenarios? The first bad thing that could happen to the plan in practice is a very sudden drop in equity prices. Okay, so if there's a market crash, stock prices crash, then the liabilities will not necessarily go down, but the assets will go down because the assets of the plan are sometimes heavily invested in equity. So if equity prices plunge, the asset value will plunge suddenly and the liability might not necessarily move. Okay, so to protect yourself against these scenarios, the pension plan manager could purchase equity put options. So equity put options, they provide payoffs when the value of stocks go down. So we can see that if you purchase a put option, well, the price of stocks might go down, but you might receive a payment from these put options in the scenario too, and these payments might push the value of assets up in that particular scenario. So we can see that equity put options are a suitable way to protect the pension plan against a sudden drop in the value of equity. Now, another situation which could be very problematic for pension plans is when interest rates decrease. Okay, so if interest rate decrease, then when you calculate the present value of liabilities, the discount rates are lower, so the discount factors are higher, and the liabilities they are suddenly worth much more than they did before. Okay, so a decrease in interest rates will push the value of liabilities up. So often, when rates decrease, it pushes the liabilities up, but this is often partially offset by an increase in the value of assets, because the assets, as we said, it's often partially invested in bonds, and when interest rates go down, the price of bonds go up, so there's some increase here, which might partially compensate the increase of value of liabilities. Okay, but this increase might be partial because the plan is typically not invested only in fixed income, it's also invested in equity, and smaller interest rates, of course, this will push equity prices up, but maybe not as much, so this can still create a problem. So to protect the pension plan against decreases of interest rates, pension plan managers could purchase derivatives on interest rates, okay, which provide a payment if interest rates drop. We haven't studied interest rate derivatives in the current course, but if you do more advanced course, you can study them, and they have similar characteristics to equity derivatives in the sense that they might provide payment if interest rates plunge, zero payment if interest rate go up, and or vice versa. Okay, so you might have something like that. So we can see that the pension plan managers, they're very worried against scenarios where either the asset value goes down or the liability value goes up. And we saw two deals which can protect them against these very unfortunate scenarios. The first would be to buy equity put options to protect the policyholder against a decrease in assets. The second scenario, which would be unfortunate, is a decrease in interest rate, and they can purchase interest rate options or options providing payoffs related to interest rate to protect themselves against this. So here I've put the reference from where I picked at least some of the topics discussed in this chapter. You can have a note at this document if you want by Googling it out. And this completes the course. So it's been a pleasure to teach you. This is the first time I teach an entire course outline. So I've quite enjoyed the experience, and I hope you've enjoyed it too. So have a nice day, and have fun studying the material. Thank you.